All right, welcome back. Today is October 9th. This is virtual class, the final one before the second exam. Today we're going to talk about the final chapter that we'll cover before the second exam, which is chapter 8. We're going to go with a Camtasia recording because the sound is a lot better than what we picked up with MediaSite. And the main topic in chapter 8 is absorption versus variable costing. As we'll see at the end of this talk, there are a couple topics that seem just added on into this chapter. They're meant to integrate different things we've talked about so far this semester. If you're looking for like one broad umbrella label for chapter 8, it might be cost-based decision making. But again, the major topic is absorption versus variable costing. Absorption costing is what we've been talking about the majority of the semester. Absorption costing is required by generally accepted accounting principles and required by tax reporting. So that's what companies use, and the chapter compares absorption costing to variable costing, which companies can use internally, but they rarely do. Regardless, these two types of costing systems provide some kind of relationship between chapters 3 and 4, where we split fixed and variable cost, and the most recent three chapters, 5, 6, and 7, where we look at how costs are actually calculated. The one thing to keep thinking about in this chapter and in some future chapters is that fixed cost cause decision problems, right? When we unitize fixed cost, it makes it difficult to think, well, what action should I take? So we'll try to illustrate that. Here's a very hokey looking textbook slide with a guy that looks like an accounting teacher. And here are the rules of absorption costing. It's something that by now you should have down cold. Material, labor, and overhead. Those costs are what go into products, right? And in accounting, inventory is the generic label given to products that companies make. The chapter is going to focus on what would be the benefit of splitting fixed and variable overhead, something that is a little bit tricky to do, right? In reality, when companies report what their products cost, they put all the overhead, all the manufacturing overhead into product cost. So they do not split fixed and variable overhead. Absorption costing puts them both into product cost. If you were to use variable costing, you still put material and labor into product cost on the assumption those are both variable, but there is some decision-making benefit to excluding fixed overhead. All right, just like in chapters 3 and 4 we looked at, there's a planning benefit to separating fixed versus variable cost. Variable costs move, fixed costs don't. Whatever, let's look at an example. All right, here's an example. And what we're trying to illustrate is the problems related to putting fixed overhead into inventory cost. All right, so here we've got a company that has no beginning inventory, which makes the illustration easier. They're going to produce more than they sell, right? So they're ramping up inventory, and then we get some cost information. We know the variable cost per unit. This is given. So it costs $200 a unit to produce these items in variable cost, and then we have some fixed cost, right? The $250,000 fixed overhead is our key. So what we've done is split fixed and variable cost. Here are the numbers to really focus on. This 250,000 fixed overhead, and we make 10,000 units. All right, so that's our real key. What's going on under variable versus absorption costing? Right, under absorption costing, your inventory will appear to cost more because you're putting fixed cost into each unit. All right, so we are unitizing fixed overhead. And we've talked a lot about fixed overhead so far in this section of the course. We'll talk more about it as we progress through the remainder of the course. But we took that 250,000 divided by 10,000 units, and that's the 25 bucks per unit of fixed cost going into each unit. That's required by GAAP. An alternative would be variable costing, where fixed overhead does not go into product cost, but your $250,000 of fixed overhead, which could be your building and various things, that cost doesn't go away. Under variable costing, what you do is simply expense that amount, right? Under the thought that you can't really attach the fixed cost to any particular unit, and so don't do it, right? Just expense the 250 grand. Here's a pretty decent slide in terms of summarizing fixed and variable cost. The only change is that fixed manufacturing overhead. It's a product cost under GAAP, which is absorption costing. It is a period cost under variable costing. So the 250 grand would simply be expensed. Here's the key item to understand, right? That there is, this can make a difference in terms of reported income. And my opinion, the big benefit of this comparison is to illustrate how companies can manipulate their reported income by trapping expenses on the balance sheet. All right, so we're going to focus on this first line. If you make more stuff than you sell, which is what happened in our example problem, 10,000 units were made, but only 8,000 units were sold. Right? If that's the case, absorption costing's net income will be higher than variable costing's net income. Right? And the reason that's true is you have trapped some fixed cost on your balance sheet. And so it didn't become an expense and it didn't reduce your net income. Specifically in our example, we put $25 per unit into each unit, and we made 2,000 more units than we sold. Right? So 25 bucks times 2,000 units is 50 grand that would not be expensed under absorption costing in the current period. Right? It's trapped on your balance sheet. The reverse is true if you make less stuff than you sell, right? In order for that to ever happen, you had to have some amount of inventory, like excess inventory that you're selling. If that's the case, absorption costing's net income will be lower than variable costing's net income. Why? Because under variable costing, your fixed overhead, to use our example, is always 250,000 bucks every period. 250,000, 250,000. Under absorption costing, this net income will have 25 bucks from every single unit. All right, now these things are timing differences, right? So if you made the same amount that you sold, the net incomes will be the same, barring some inventory flow assumptions. And so the beauty of double entry bookkeeping is eventually any kind of game that you play to manipulate income will catch up with you, right? But in the short term, you can manipulate income in a GAAP-based world by just making a bunch of stuff, right? By making a bunch of stuff, you trap fixed overhead on your balance sheet, and so it is not an expense. That's the big complaint against absorption costing. It produces bad incentives, right? You just can make a whole bunch of stuff, and if you want to jack up your income, making a bunch of stuff spreads your fixed cost over more units. That cost does not get expensed until you sell the units. All right. So what's better, variable costing or absorption costing? Got 3 slides here that I'll talk about. It's kind of a philosophical issue. Little characters make arguments in favor of variable versus absorption costing. But know that absorption costing is what actually happens and must happen for financial reporting purposes. Variable costing is a managerial choice, so unless you think you get a benefit out of it, you won't do it. Check out those arguments on your own. A philosophical argument, the big picture is what are you doing with fixed overhead? All right, so that's the bulk of Chapter 8. Remaining discussion in Chapter 8, it's two topics. The first is segment income statement. So for companies that make multiple products, like this example, we've got a company that makes MP3 players and DVD players, right? The kind of key to segment reporting, which we'll see again in the third part of the course, is if you have some direct fixed overhead, meaning I don't know, a machine that only makes MP3 players, then charge that cost to MP3 players. If you've got some kind of machine that only makes DVD players, charge that cost to DVD players. But at the same time, you can have some common cost, right? Like the building. You might make both MP3 players and DVD players in the same building. Segment reporting would say do something like this, which if you look at this slide, it basically, and comes out of the textbook, what the slide does is it splits fixed and variable cost. And so in large part, we revisit chapters 3 and 4, right? We have contribution margin again. Simply because it makes more sense to split fixed and variable costs. These amounts will move as you sell more or less. We have some direct fixed cost that you can attribute to the segment, in this case MP3 players, or over here DVD players. And then we have some fixed costs that we simply don't know what to do with. They relate to both products. We're not exactly sure how. That's kind of the argument for segment reporting. We'll see more arguments later. Final topic in Chapter 8 deals with inventory management. In some ways, this topic just seems to be stuck onto the chapter. It's meant to be some kind of link to other chapters and other courses, specifically operations management. And when you look at chapters 5, 6, and 7, they all talk about what is the cost of inventory. Cost is important to help you manage inventory. We get equations like this economic order quantity. Basically, all it does is helps you think about balancing two different things. One, the cost of placing an order, and two, the carrying cost of inventory. We'll look at some example problems with economic order quantity during class on Thursday. It's a technique to choose the right quantity of inventory to order. It does make a heroic smoothness assumption that looks kind of like this. You take your inventory and just smoothly produce it until some magical point where you need to buy more inventory, and then you smoothly produce it. The textbook does a reasonable job of saying, what are these endpoints? We're not really sure. Like, what's the maximum amount of inventory you should carry and the minimum? Textbook will talk about things like just-in-time inventory, which says this should go to 0. But that's sort of unrealistic, because if anything goes wrong and you run out of inventory, you can't produce, which is a pretty awful outcome. So anyways, we got this add-on thing of economic order quantity and inventory management that tries to round out these chapters where we have largely discussed what does it cost us to produce an item, and that cost is the cost of inventory, at least to accountants. So that's Chapter 8, kind of a hodgepodge, with the big thing being absorption versus variable costing. We'll look at some problems related to Chapter 8 on Thursday. Until then, I hope the sound worked better than MediaSite.